Hey, welcome to the Closing Beat, everybody. Happy Friday. Hope you had a great day today. This is our quick stock market update show where we cover, the good to bad. What happened with the stock market today? Really, this whole week has been basically the same, but we walked you right through it step by step. We're financial advisors here at Jazz Wealth. We like to say we work with investors of all sizes. So if you have retirement accounts, things you're working with, investments that you just don't understand, don't want to deal with, or maybe you're working with some guy, he's just not calling you, he's not working with you there, well, we hope you'll keep us in mind here at Jazz Wealth. Also, we've been playing a game. Today is the first game, the results of the first game. Bottom right-hand corner of your screen, we're calling it Guess the Dow. All you have to do is guess where you think the Dow is going to close in the next week, and we'll send you $100. We have our first winner. His name is Ram Kumar. I think that's a pretty unique name. We don't have to give out the last name there. His guess was $26,022.50. Or 0.50. So he was the closest without going over, and notifications going out here shortly. And $100 is on the way. It's a gift card, no strings attached. He's not an existing customer, so no choice to credit his account. But if you are one of our customers and you do want us to credit your account, we can do that. The $100, and it doesn't count towards your IRA maximum for the year, of course. So congratulations to our first winner. You have until the end of tonight to go guess where you think the Dow will close next week. So we'll do it again, giving away another $100. I appreciate you guys playing. A lot of people playing there. I really, really appreciate it. You can guess once a week, so feel free to guess for this week, and then you can guess next week as well if you'd like. Update here, little homework. Next Monday, Tuesday, and Wednesday, there'll be no closing beat here. I'll be on a really short sort of daddy-daughter vacation there, so we'll be back. Also, if you're one of our customers, we did our class last night on the distribution of returns in the S&P, how long it takes to recover from losses on average. We did a little historical look back there, so you can kind of see what to expect and when to expect it when the markets eventually fall, and they will fall. There will be some scary moment in time. I like to prepare people ahead of time for that. So that's all I have for homework, right? I cover everything I need to cover? Yeah. If you want to play the game, go ahead. Down bottom right-hand corner of your screen is the website for that. All right, so this morning, markets, we come in. What do we have to digest? We have some industrial output from China overnight. Came in a lot weaker than expected, so Mr. Trump had to feel pretty good because it shows that a lot of manufacturing is slowly leaving China, and the manufacturing that's currently in China, they've reduced their output, which means a lot of manufacturers are probably thinking, you know what, I better just go somewhere else, making that switch. Taiwan, Bangladesh, India, to name just a few places where a lot of manufacturing is moving from making clothes to technology and things like that. All right, we had retail sales numbers come out here today. It was a miss, but really it was a beat. It's kind of hard to say. Retail sales as a whole missed expectations, but a lot of people like to back out auto sales and gasoline because of the volatility in the gasoline there. And if you do back that out, then it was a great number. Retail sales did really well. There's actually 13 categories that are tracked, different areas of retail sales, and the best performing area was online. Apparently everybody's online buying stuff. That was up 1.4% month over month. Interestingly, electronics and appliances also, they came in second place, 1.1% gains there respectively compared to last month, despite having the exposure to the tariffs and having to deal with that. Sporting goods making a strong comeback, coming 1.12%. That was in third place there. And auto parts and things like that were in fourth place. Your worst performing areas in the retail sales world were food and beverage stores and the miscellaneous, which is really just a hodgepodge of nastiness in there, and sort of an easily converted number. Doesn't get a lot of attention. Clothing also came in towards the bottom of the list. I don't know if you like that sort of thing, but that's where we're at. So because of that, and the China news, stock market had a hard time getting anything going today. There was really no catalyst in the market. We've been saying that all week. There's really no reason for people to buy or sell aggressively. And so because of that, you got the Dow basically flat on the day, lost 17 points, not a big deal. S&P lost 4, NASDAQ lost 40. Tech really got hit pretty hard here today. Here's the stock market, S&P 500. This is in our dojo. We have a dashboard here for customers where they can go and kind of see where the markets are at. You can also look up individual symbols. If you're following along individual stocks and maybe we've talked about it, then of course you can check it here in the dojo. So the S&P 500, we talked about this big V-shaped rally off the lows coming into the first part of June. Strong rally, however, we mentioned earlier in the week, the market tends to be slightly negative going forward 7 days. So far, that's on track. Actually, the market's a touch positive there for the week. But all in all, sleepy. Sleepy was the name of the game. It's what you wanted. It's what we got. You never want to see the markets rally strong and then continue that rally or start to pull back aggressively. You want a calm little pullback. This applies to stocks as well, if that's something that you like to track. Again, think of the emotion. What's the emotion with somebody who either bought in here or has owned the market for any length of time? We've zoomed out in previous sort of examples to say there are so many different areas where you could literally have invested in October of last year and just be breaking even. You could look at your IRA or 401k or whatever you're looking at and go, why haven't I made any money? Well, that's because you lost a whole bunch, then you recovered all of it, and the market's trying to decide what it's going to do next. So if you've invested any time in the last year and you haven't noticed the greatest performance, chances are you bought somewhere between the end of besides like December and November, you bought towards the middle to end of last year, or you bought somewhere in the mid portion of this year as the market was rallying, or maybe your average cost is somewhere in there. And so you notice either just a small gain or break even. Totally normal, nothing to worry about there. Now, here's the NASDAQ real quick. That's performing a little bit worse. It's struggling with that 50-day moving average. If I zoom in a little bit, you can see it just had a hard time getting over it. Not a good sign here in the short term. Next week, we'll definitely change that, because next week we have the Federal Reserve talking, and look, a lot of people think they're going to cut rates. Actually, where's my notes? Traders think there's an 86% chance that they cut rates by the end of July, or the last meeting is at the end of July. And so, big chance that Fed cuts rates. However, there's no reason for the Fed to cut rates, even with all the data that came out this week and last week. Granted, the Fed's sort of operating on old data, and they're looking at the data going forward. There's really no reason for them to cut rates. So next week, if you think the Fed's going to cut rates, I personally think you're going to be wrong. I can say that because I'm not giving you advice to do anything there. And we'll see. So I'll be back, of course, on Thursday. We'll cover that. But I don't know. I just don't see the Fed cutting rates. I think it's way too soon. I think they'll make comments that say that they're interested and would be willing to. And of course, they'll support the markets and they'll do whatever it takes to avoid a recession. Keep inflation at their target, which inflation dropped a little bit, but they'll try to keep it. Remember, they want 2% inflation right now. They're having a hard time getting that. And so I just don't think you're going to see a rate hike next week. Let me know what you think in the comments below, but I don't see it. We'll cover it, of course, as it happens. Obviously, traders seem to think that maybe not this go around, but the next one is when they're going to cut rates. We'll see. Also, with the tariffs, you have Trump that could potentially say at the end of this month, okay, we'll take the tariffs off China. Or, okay, we'll add the rest of the tariffs on China. And so that ability for him to flip a switch leaves the Fed to play sort of catch up. I just don't think they're going to get in the middle of that. I don't know. This is my opinion. Year to date, you've got every major index higher by at least 10%, so double-digit gains there. But that's year to date, remember. Unless you started investing this year, you could be flat, right? So you may not have double-digit gains in your portfolio, but you may have double-digit gains year to date. That's really where you want to look at. I've been having fun kind of showing customers like, look, our portfolios beat the market, if that's how you're invested, year to date. Now, if you've been with us for a year and a half and you happen to start at those highs, of course, there's going to be a little difference there. But that year-to-date performance doesn't lie. If you're working with an advisor of some kind or you're investing your own account, sort by year-to-date and just see, are you keeping up? Are you trying to keep up or beat the market? And if so, what does your performance look like? You may want to take a look at that. It's been a great market to measure success here, or room for improvement, of course. All right, 55% of the S&P 500 is over the 50-day moving average. We've hovered around 50% all week, and you kind of understand that the markets here have been just sort of sideways. If we go back to the S&P 500, when you have a market that's flat, you have your standout stocks and you have your weak areas. So I've done a good job just kind of pointing out where the standout sectors are. I'll do the same today, and where the weak areas are of the market. Technology has fallen into 5th place now for stocks that are staying above the 50-day moving average. So I try to point this out on a daily basis so you can identify when weakness starts to hit. Technology has shifted from 3rd place to 4th place down to 5th place all in 1 week as far as the sector performance there. And that's a lot due to what happened with the semiconductors today. We'll cover that as well. In the S&P 500, you got 35 new 52-week highs today, a slight uptick from yesterday, and a lot of it's just the continued strength from yesterday. We talked about Under Armour yesterday, hitting new 52-week highs. The momentum in Under Armour, no matter what class of stock you're looking at, of course, is continuing. Walmart, that momentum continues for Walmart, poked up to 52-week highs today. Not a lot of progress performance-wise today, but you can see that a lot of this is just that momentum from your relative strength areas continuing. Starbucks moving higher. You had a lot of REITs this week continue their momentum. A lot of REITs today over hitting new 52-week highs. Doesn't really matter which ETF you like to use. I think we have... What do we have here? We have Fidelity's ETF. You can use any real one that you like. Any of the index-related ones are all pretty much the same. Disney also touched up there to new 52-week highs. Remember yesterday, the good news there, the upgrade, and it got a little bit of a boost today. It was basically flat on the day overall. You got 4 new lows on the day, and unfortunately, all of that's going to be energy and oil-related. That's your weakest area of the market. Anything energy-related, XLE, there's a relative weakness there, and continues to be weak. Simple as that, right? It's just a standout, obvious weak area of the market and continue to do that this week. All right, let's talk about the semiconductors. You got a gap lower on the semiconductors, and that's sort of our focus area today as far as the study goes. Semiconductors gapped lower, or the SMH, by just over 2.5%. 2.55, I think, was what it gapped down today. And so we look back and say, well, that's only happened 15 other times in the last 5 years. We didn't go back much further than that, just didn't have the time today. And when you compare that to the S&P 500, anytime that the SMH gapped lower, the S&P 500 gapped lower as well. So you notice how I always say you need the semiconductors and you need the financials. What I'm really saying is you need tech stocks and you need financials to have any significant move in the market. Well, you had financials today, but you had tech stocks selling off there. So the expectation is when you see the semiconductors gapping lower by such a large amount, 2.5%, you know that the market's going to at least start the day lower. It's never been that way. In the last 5 years, it's never been where the semiconductors gapped lower and the market somehow just gapped higher. Now, throughout the day, of course, there could have been some news and the market's finished higher, of course, but that's kind of how things are right now, so now you know. Bonds, a little bit higher today as far as price goes. The 10-year, 3-month inversion persists, right? You guys follow the inverted yield curve here? Do you care to track that at all? I'm sort of testing it out on you guys today. I don't talk about it often, but we're working on, well, this is officially the 17th day that the 3-month has yielded more than the 10-year, 17 days in a row. If you look back in history, a lot of people are going to say, oh no, that means recession's coming, and that is technically true, but specifically, let's dial in. Let's see when does that actually hit. And all but one recession in the history here of the markets, all but one recession started after the inversion between the 10s and 3s, 3 months, were inverted for more than 50 days. So we're inverted for 17 days. Well, it's not great, right? That's still a warning sign, but all of the recessions, besides one of them, happened when the inversion lasted 50 plus days. The only other time that we fell into a recession beforehand, and actually I think it took about 6 months afterwards, was 1968. And so the inversion lasted 30 days, and then the markets went into a recession slightly afterwards. So we're not there yet, right? When you see that on TV and they keep pointing it out, especially as it gets into 20 days and so on, we're not there yet. We're, of course, warning sign, you're feeling it. We're starting to see that this is a possibility, but that's sort of your other data point for the day. I don't know. I like to pick something and focus on it. All right, let's look at the sectors here. Utilities, you'll notice in the dojo up at the top of the list, this is the lesson of the week for customers. We have literally walked you through, did a class on this being overpriced and overvalued and saying watch and wait for it to pull back. That's exactly what we covered. It's exactly what's happened here. Makes sense. Now you understand why when you look at a stock, you look at a sector, you look at a stock market index, and you see an overpriced, overvalued area, you now know, hold back, right? All my active traders out there, for some reason we attract active traders here to Jazz Wealth, that we manage their retirement and help them with all that. But now you know, avoid it. Put it on a watch list. Come back to it a little bit later and see if there's something there for you after a pullback. So utility is really the lesson of the week and also the strongest of the day. Your overbought areas of the market, right? If you like to pay up, right? Like Jim Cramer used to say, buy high and sell higher. That was his that was his idea. And he's not wrong. What he's saying is buy good quality stuff and sell it for a higher price, right? Ride the momentum. That's the way he likes to do things. And so if you like that, you're looking at things like the XLU, you're looking at consumer You're looking at consumer staples. Yeah, it's overbought in the short term here, but that's your momentum. Those are your better performing areas there. And REITs, you got to point out REITs too. We mentioned that a minute ago. They've done really well. On the downside, we mentioned already energy. That's your relative weakness. If you're the person that says, I like discounts, I know these things will recover at some point, I like to buy cheaper stuff, you're probably focused more on energy and energy stocks, anything oil related, oil service companies, oil transportation companies, drillers, explorers, you name it. You're probably looking in that category. Natural gas even is probably where you're focused. You could also be looking in the communications services sector. It's not necessarily oversold or sort of deeply discounted in the short term, but it's lagging, right? So it's not fully participating with the market, which is pretty obvious if you take a look at just the recent performance here relative to the market. Much different there, much stronger rally on the upside there. So I don't know. I'm just sort of testing some things today to see what you guys like. All right, the reason the semiconductors gapped lower today was mostly because of Broadcom. That took down all the other areas. Now, I could give you the news and be all like, earnings. What do we have here? They beat on earnings, revenues were weaker, and they lowered guidance. But what's the real reason this thing was so weak here today? Let's chat about it for a second. Remember last quarter, the Broadcom, we had Intel, Micron, and Broadcom. They came out, and they all sort of had differing opinions on how the rest of the year would pan out. A lot of them were negative, saying, we have not reached the bottom in our excess supply. We've not reached the bottom in the memory sort of slowdown that they have been experiencing. Broadcom comes out and says, we hit the bottom. This is it. Nothing but higher from here. The CEO was so positive last earnings season, or last earnings announcement, he went nuts. And so because of that, if you look back, look on the chart. There you go. What happened? Stock enjoyed a really great day because we had just got all this bad news from Micron and Intel and stuff, and here comes old Broadcom. All the investors thought, well, Broadcom must have it figured out. Let's go invest in Broadcom. And so the stock shot higher. He completely changed his tone this go-around. He said, now, to sort of get ahead of this here, first of all, you know the deal with Huawei, right? Can't work with Huawei anymore. They've been blacklisted. Broadcom gets about $900 million a year from Huawei. So right off the bat, you go, holy cow. When this came out here, that Huawei ban was in place, Broadcom got hit the most. They got a lot of revenue coming from them that they no longer can expect. It gets a little oversold, stock bounces. Anyways, they come out with earnings. You kind of expected the guy to say, well, we're sort of hurting from the whole Huawei thing. We hope that the Americans can work things out. No, he didn't say that. He said, Huawei aside, we're experiencing broad slowdown. This is horrible. He went on and on to say, we're weak. This is a broad sort of thing, and it's not Huawei focused. Well, of course the stock's going to gap down, right? He sort of asked for it there. The bottom line is, remember, last quarter, he was all positive. This quarter, we expected a little negativity. He went full force, threw the kitchen sink at it. And a lot of times CEOs will do that to just take the hit right away, and then anything from there doesn't seem so bad. I don't know that that's the case this go around. We'll see what happens. Fiverr, second day of trading, pulled back 21%. You got Chewy, first day of trading today, the new IPO, great IPO. It did really, really well, actually. I didn't cover it. They priced at 22. I think they were up like 80% on the day or something, so really good. I mean, it was a good first day for them. And PetSmart, of course, as well. Chewy is now worth over $1 billion, if that's something you happen to pay attention to. All right, some news out of Facebook. Yeah, a couple things. Wall Street Journal did a whole deal on Facebook. They're going to spend more money on their ad spend, and the whole privacy thing is just kind of in focus. The stock was a little bit higher here today. And then other than that, there wasn't a whole lot. I don't know. If you happen to follow and you pay attention to Sony, that stock was a little bit higher today. You had an activist investor say, hey, you guys should just spin off your chip making business. It would make Sony much more valuable. I don't read into that enough. I'm not too familiar with that one, so I can't comment too much. Other than that, I think we've covered it. Do you have any questions? I'm happy to answer. Brandon says he thinks a Fed cut and no trade deal. All right, that's cool. I like this sort of, we have some fun with something for a change here. Why do investors want a rate cut? You got to do some due diligence on that. Annette is asking the question there. It's not that they want it, it's that they're preparing for it. So basically your bonds traders are saying, we think there will be a cut. They're pricing their positions in that way. You technically don't want a rate cut. In our last class that we did for customers, we went through that data to see what happens after the Fed cuts rates for the first time. What does the stock market do? It's not pretty. We do not want a rate cut after already just raising rates. And also, if they do cut rates either to, next week or in July, that would be the shortest span of time where they've ever raised rates, then cut rates. That's not good either. So how the market is historically going to respond is very negative. So it's very positive in the short term, in the first month, the first week, of course. But as you go further out, it's not pretty, man. We showed the data to all of our customers in there because that was a study that was worth sharing and sort of get you on the camp to say, no, don't cut rates. Please, don't hurt me. Yep. Europe has negative rates. What else could the Fed do? Yeah, they've talked about that when things were really bad. They did talk about the possibility that they were open to going negative on rates. There's not a whole lot of room for them. So if we really do get severely weak here, how much can you cut rates? I mean, we're basically right off zero anyways. So you got a good argument there. Yep. I saw that Facebook got taken out of the environmentally and socially conscious index that's just been put together there. I think that's a big deal, personally. There are more and more people that are interested in investing to, of course, hit their goals, but they want to do it in a feel-good kind of way. They don't want to do anything that hurts the environment or animals and things like that. It's not really a big deal right now, but I think it's a big deal long-term if this environmentally, socially sort of conscious investing takes flight. And they're really marketing the devil out of it, right? So they're really trying to push that this is okay to invest this way. Not enough data for me to say that you will historically perform as well as if you take that out of there. So I haven't covered it a whole lot because I don't have the data to say that, yep, that's worthwhile to do. So we'll see. Dustin, what's your guess next week for the Dow? Dollar or point-wise, I wouldn't know. I put in our terms that, of course, I could play if I wanted to play, but I wouldn't be able to win. I think we'll end up lower, if that helps you in any way. You will get activity. So if you thought this week was boring, you're right. But next week will be active, especially later in the week with the Fed coming up there. And who knows what old Mr. Trump's going to tweet. Remember, you got that upcoming G20 meeting where they're hoping to get together. If that doesn't pan out, that could be pretty active as well. Or if he tweets about it, says some things like that. Dustin, when you make a dividend portfolio, what percentage yield do you like to target and why? I'm really geeky about this one. So our goal is not necessarily a yield because you can't always control that. Our focus is on the probability of being paid, the cash flow from the company and the history of them paying. That's a big one for me. And then from there, we look to see how low can we bring the volatility down. I'm not really interested in like, oh, can we market that we hit like 4%, right? Our dividend REIT and growth fund, they yield over 4% at the moment. That doesn't matter to me so much because if you're yielding 4% but the volatility is at 20%, nobody wants that, right? So for me, it's getting the highest probability we're going to get paid, consistently being paid, the biggest companies that continue to pay and have a history of paying, and then how do we tweak it so that we bring that volatility down? I don't want you to see a lot of back and forth in exchange for, 3-4% yield. So that's more of a focus for me there. Any portfolio that we have, not only are we trying to shoot for whatever goal we've listed on the website there, it's all public, but from there, my sort of day-to-day goal is, can we bring the volatility down? Any way we can bring the volatility down, that's important to me. And that doesn't mean you sacrifice performance. I'm going to do a video next week on those low volatility ETFs. They beat the market. Like people say, you can't beat the stock market, man. You can't do it. I got 2 great examples of ETFs that have always beat the market and done it in a way where there's less volatility. So I'll share that with you guys as well. Yep. Cool. Don, yeah, same thing. I think the markets move a little lower next week. I just don't see the catalyst. I think the Fed not cutting rates next week is expected unless they just say something like, we are actively monitoring to possibly press the button and cut rates. I just don't. where do we go? Anything that happens next week is still going to be news driven, very light on econ news and very light on earnings that are left over. Yep. Do we assist with 501c3 tax deductions? Nope, that would be a CPA. You don't want to get that wrong. Make sure the person that does your taxes does a good job. Cameron says, buy the fast passes at Cedar Point. I agree. That's a good deal. We actually got the deal with the hotel tickets and fast passes, which I was thinking about sharing that with you guys. Like, I found a trick to get discounts on things, and it's really stupid, but maybe we'll make a video out of it because it's the silliest thing. But Dave & Buster's I'm going to on Sunday in Orlando. Got a 50% discount on filling up your card, and we got discounts at Cedar Point as well, all from just the dumbest little thing, but we'll see. You're buying AT&T, you're buying Exxon. Should you stop? And what do you think about those? Well, so you're not buying AT&T because you think it's going to jump 20% this year. You're maybe buying ExxonMobil because you have a directional bias and you think it will eventually end up higher and you'll see some growth there as well. So those are two a little bit different categories. AT&T is definitely a dollar cost averaging thing. It's like Verizon. They do well, they pay well, they always pay. They very rarely cut their dividend. So I can understand whether it's higher or lower, you trying to build a big position there so that you can get some of that passive income. ExxonMobil is more of a discount area right now. You could probably see, if we could share the chart, it's very, very discounted here in the short term. I think you're going to see more of that. These types of stocks and oil, commodities in general, they trend. These types of things trend for a while. I'll tell you what, since I'm not going to be here for the closing beat, I'm going to post a video at 5 o'clock specifically about this type of reversal here for you, just so those of you that like the sort of active thing, you get something out of the day as well. Could you potentially see a rally Monday and Tuesday in the markets? Sure. Anything's possible. The Monday activity, usually news-driven. I would have to guess what the news was there. I hope it rallies. I mean, now we've paused, in my opinion, long enough to get a little leg up there. Nothing crazy, but just a little bit of a leg up I think would be great there. Brianna's got it right. That's the right idea for AT&T. Long term and your dollar cost averaging, just keep reinvesting those dividends. Daniel, thank you so much. Looking forward to it. I don't like not being here, but I will. I'll try to walk away for a little bit. Domino's is a tricky one. That's very competitive business. Low margins, very difficult for any increased growth. I like what they're doing just to try to grab attention with all the different delivery options and hinting at the whole drone thing. But that's a tough one. If you're looking to just sort of cherry pick a stock, that's not where I would look. Yep. Don, don't forget to get Buckeyes while you're in Ohio. Care to share what that is? I'm ignorant. I don't know what that means. I love it. Broadcom versus AMD and NVIDIA. Well, this is tough, right? Because you have that sector is not moving because of earnings so much. It's trade related, it's geopolitical events, it's shifting of manufacturing. We don't know, right? So you can't possibly know that kind of stuff unless you're in the industry and things. So because of that bugs me. If I had to choose, I'd choose the ETF just because I'd want to be more spread out. Sometimes that happens, like in the energy category, I would not choose the energy ETFs. I'd go hunting for good deals. You know what I mean? I would put the effort in and go that way. When there's a lot of geopolitical type news, well, you know what's going on. For me, that one means I would go more diversified. Simple as that. Did we announce the Dow winner? Yes, we sure did, and the email should have already went out or is on the way out to the winner. Did we say the number? By the way, the number, which at the day, right? Throughout the day, I was kind of watching to see who was going to win. It shifted many, many times, especially right at the end of the day. 26,022 and 50.50 was the winning guess there. Yep. A Buckeye is like a Reese's cup, but round and way better. Oh, I'm in. Yeah. Well, no. Yeah, of course. I love Reese's. You're kidding me. Oh, well, now I'm excited. All right. Well, I'm definitely not going to be here Monday, Tuesday, or Wednesday. You guys enjoy the rest of your weekend. Happy Father's Day to all the fathers out there. Be safe. Have a good time. Do something relaxing that you want to do. And we'll be back later next week to keep going. But I'll post some videos, of course, along the way so you guys have something. I appreciate you guys supporting us, really do. Whether you hit the subscribe button or you're just here watching or whether you're one of our customers. I mean, every little bit to me is awesome. The fact that people actually watch this blows me away. So enjoy your weekend. Enjoy the rest of your day. We'll see you next week.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.